Most men come to the market believing action is the same thing as progress. I learned early that this is the most expensive belief a trader can hold. The market does not reward activity, it rewards correctness, and correctness usually comes from waiting. Have you ever noticed how your worst trades come when you feel the urge to do something, anything, just to be involved? A man can be brilliant and still lose money in the market if his timing is wrong. I've seen it happen more times than I can count. Intelligence gives you opinions, but timing gives you profits. The market doesn't care how smart you are, how many books you've read, or how confident you feel about a stock. It only responds to when you act. Haven't you noticed how a trade can be right in idea and still wrong in result? Most traders fail not because they don't understand charts, but because they step in too early or too late. They see a setup forming and can't wait for it to finish its work. They want to be first, but being first is expensive. The market rewards the man who waits for proof, not the man who guesses. Isn't it strange how patience often looks foolish right before it looks wise? Timing is the quiet skill no one likes to practice. It requires sitting through moves that don't belong to you and letting opportunities pass without regret. That's harder than analysis. Anyone can spot a pattern, very few can wait for it to confirm. The tape always tells the truth, but only after it has finished speaking. A well-timed trade feels calm. There's no rush, no inner argument. Price aligns with trend, volume supports the move, and risk becomes measurable. That moment cannot be forced by intelligence alone. It arrives when the market is ready, and the trader who respects timing keeps his capital for that moment, knowing that being late is safer than being early, and that the real test begins when the setup is almost there but not quite, when the mind wants to act, but the chart has not yet agreed, when waiting becomes uncomfortable and the clock seems louder than the tape, and the trader must decide whether to trust time or to trust his own urge to move. The market has its own rhythm, and it doesn't speed up just because you're impatient. I learned that lesson the hard way. Prices move when conditions are right, not when a trader feels ready or anxious. You can study charts all night, mark every level, plan every scenario, and still be early. And being early in this business is the same as being wrong. Have you ever felt certain about a move, only to watch the market sit still and drain your confidence? A trader must accept that the market is never late. It moves precisely when it should. The problem is the man who thinks he should be involved every day. That kind of thinking leads to forcing trades, and forced trades rarely end well. Waiting for the market to act first keeps you aligned with reality instead of opinion. Isn't it interesting how the hardest thing to do is often the most profitable? Markets go through quiet periods, and those periods are not empty. They are forming the next move. The patient trader watches volume dry up, range tighten, volatility compress. He knows something is building, but he doesn't rush to name it. He waits for price to confirm direction. That waiting sharpens discipline and protects capital. When the market finally moves, it does so with purpose. That's when preparation meets opportunity. But if you've spent your energy chasing small moves before that moment, you won't be ready when it counts. Timing is not about predicting the future. It's about respecting the present. And the present often says, not yet. The trader who survives long enough learns to move only when the market invites him in, to let price lead and emotion follow, to understand that readiness is meaningless if the market is not prepared, and that the real edge lies in accepting stillness while others mistake motion for progress, sitting quietly while the crowd grows restless, knowing that every major move begins with a period where nothing seems to happen and the chart looks dull and uninviting. Most people think a position only exists when money is committed, when a trade is on and something is moving. That belief alone costs traders more than bad analysis ever will. Waiting is a position, and often the most intelligent one you can take. When you are not in the market, you are protecting capital, preserving judgment, and keeping yourself available for the right opportunity. Isn't it curious how doing nothing feels harder than doing something, even when doing something is clearly the wrong move? Inactivity is misunderstood. A trader who waits is not idle, he is observing. He is reading the tape, studying how price reacts at key levels, watching volume speak honestly when news lies. By staying out, he avoids being emotionally compromised. The moment you enter a trade too early, your thinking becomes attached to hope. When you stay in cash, your thinking stays clear. That clarity is a position in itself. The market offers endless chances to participate, but very few chances to participate well. Taking every swing does not make you active, it makes you vulnerable. Waiting allows you to be selective. It keeps you from fighting trends that haven't started and from guessing tops and bottoms that don't yet exist. Have you noticed how the best trades feel obvious in hindsight because they were allowed to develop fully? A man who understands that waiting is a position no longer feels pressure to be involved every day. He knows that preservation comes before profit. Capital is ammunition, and wasting it on impatience leaves you defenseless when the real move begins. While others are busy trading noise, he is positioning himself mentally, emotionally, and financially for clarity. The discipline to wait separates professionals from hopeful participants, because the market does not demand your presence. It demands your readiness, and readiness often looks like restraint, while price drifts, volume contracts, and nothing seems urgent. Yet everything important is quietly forming beneath the surface as time tests patience and reveals who is willing to protect capital long enough to deserve opportunity. The market has a way of charging a premium for impatience. Every rush decision carries a hidden fee, and the trader pays it sooner or later. Patience, on the other hand, is rarely dramatic, but it is consistently rewarded. The market doesn't hand money to the fastest hand on the mouse. It hands it to the steady hand that waits for alignment. Have you ever noticed how the trades you chase rarely work the way you imagined? Impulse feels productive. It creates the illusion of control. But in trading, impulse usually means acting without proof. A patient trader waits for price to confirm direction, for volume to support the move, for risk to become defined. That waiting removes emotion from the decision. It turns trading from guessing into responding. Isn't it interesting how the market becomes clearer the moment you stop trying to force it? Most losses are not caused by bad charts, but by bad timing driven by impatience. Traders see a move beginning and rush in, afraid of missing out. They buy strength before it proves itself, or sell weakness before it completes its work. Patience keeps you from paying for that fear. It allows the market to do the heavy lifting first. The market rewards those who let it come to them. Waiting for pullbacks, consolidations, and confirmations reduces risk before profit is even considered. It also trains the mind to stay calm during uncertainty. A calm mind sees opportunity more clearly than an anxious one. Over time, patience compounds. It preserves capital, builds confidence, and sharpens judgment. The trader who practices patience is not slower, he is more precise. He understands that the market will always offer another opportunity, but it will never refund a careless trade, and that every moment of restraint strengthens discipline, while every impulsive act weakens it, shaping not only the account balance but the trader's character, as he learns that real progress in trading often feels quiet, uneventful. Most losses are born long before the loss ever appears on the screen. They begin the moment a trader decides to act before the market has finished its work. Acting too soon feels like confidence, but it is usually just impatience wearing a clever disguise. How many times have you entered a trade only to watch price hesitate, reverse, or drift just enough to shake you out before moving the way you originally expected? The market is always tempting traders to anticipate. A small breakout, a hint of strength, a flicker of volume, and suddenly the mind starts filling in the rest of the story. But the market does not pay for stories, it pays for evidence. When you act too soon, you are trading what you think should happen instead of what is actually happening. That difference is where losses lie. Early entries carry emotional weight. Once money is on the line, objectivity fades. You stop reading the chart and start defending your position. A patient trader avoids this trap by letting price confirm direction first. He allows the move to mature before stepping in. Isn't it interesting how waiting a little longer often removes most of the uncertainty? Losses from early action are especially damaging because they feel unnecessary. The setup almost worked. The idea wasn't wrong. The timing was. Those losses chip away at confidence faster than honest mistakes. They teach frustration instead of lessons. By waiting for confirmation, you reduce the number of decisions you must make under pressure. You trade fewer times, but with greater clarity. Capital stays intact, and so does discipline. The market always gives signals before a real move, but it also gives many false starts, and the trader who survives learns to ignore the noise, to let others pay for impatience, to stay flat while price tests levels and emotions rise. When the market becomes unclear, most traders feel uneasy holding cash. They mistake uncertainty for missed opportunity, but cash has a purpose far greater than just waiting to be spent. It preserves clarity. When price action is choppy, when trends overlap and signals contradict each other, staying in cash keeps your mind free from attachment. Isn't it easier to see the truth of a chart when you're not emotionally tied to a position? A trader in cash can observe without pressure. There's no need to defend an entry, no urge to explain away weakness, no fear of being wrong. The chart is allowed to speak plainly. Once you're in a trade, every tick feels personal. When you're in cash, every tick is just information. That difference alone can save more money than the best indicator ever will. Unclear markets invite overthinking. Traders start forcing interpretations, seeing patterns that aren't fully formed. Cash cuts through that noise. It creates distance, and distance creates perspective. When you step back, you notice things others miss: failed breakouts, weak volume, hesitation at key levels. Have you noticed how many bad trades only look obvious after you're no longer in them? Cash also protects confidence. A string of small, unnecessary losses can damage judgment far more than one honest loss taken at the right time. By staying out during uncertainty, you protect not just capital, but decision-making ability. That mental reserve matters when the real opportunity appears. The disciplined trader respects confusion as a signal. If the market is unclear, it's saying wait. Cash listens. It allows patience to replace anxiety and observation to replace impulse. While others trade noise to feel productive, the trader in cash stays mentally sharp, ready to act when clarity returns, when price aligns with trend, when risk can be measured without guesswork. Trends don't reward eagerness, they reward timing. Many traders believe the earliest entry guarantees the biggest profit, but experience teaches otherwise. Entering too early means absorbing uncertainty, drawdowns, and emotional stress before the trend has proven itself. The market charges heavily for that privilege. Why carry that burden when patience can shift it onto someone else? A trend has stages. It begins quietly, often disguised as noise. Then it proves direction, attracts participation, and finally exhausts itself. The trader who waits for confirmation may miss the very first ticks, but he gains clarity and control. Being early feels clever, but it places the trader in conflict with the market. Being on time places him in harmony with it. Isn't it better to join a move once it has shown commitment rather than gamble on its intention? Late entries carry risk as well, but they are different. Entering late usually means chasing emotion, reacting to headlines, or fear of missing out. That kind of lateness often ends near exhaustion. Timing sits between these two mistakes. It requires patience and attention, not speed. Waiting for pullbacks, consolidations, and retests allows risk to shrink while probability improves. The chart tells you when a trend is ready. Price holds higher levels, volume supports advances, and weakness fails to gain traction. These are invitations, not guesses. Trends reward those who respect structure. The patient trader allows the market to confirm itself before committing capital. He understands that the middle of a trend is where discipline meets opportunity, where the move is strong enough to follow, but not yet crowded, where emotion has not overtaken logic. A good trade doesn't demand persuasion. It doesn't need excuses or constant reassurance. When a setup is right, it feels natural, almost quiet. There's no rush to convince yourself, no inner debate. The chart lines up, the trend is clear, and the risk is obvious. Have you ever noticed how the trades you struggle to justify are usually the ones that cause the most trouble? Forced trades come from impatience and boredom. The market isn't offering anything, so the trader tries to create something out of thin air. He starts bending rules, loosening criteria, and convincing himself that this time is different. That mental strain is the first warning sign. A good trade doesn't require effort to believe in. It earns belief through structure. When a trade is forced, emotion enters early. Fear and hope take turns controlling decisions. Stops feel uncomfortable. Targets feel uncertain. Every small move feels personal. In contrast, a well-formed trade feels detached. The trader knows where he's wrong before he's right. That clarity is calming. Obvious trades often appear after periods of waiting. The chart compresses, signals align, and price behaves as expected. There's no need to chase or predict. The trader simply responds. Isn't it interesting how the best opportunities often arrive when you've stopped trying to make something happen? The market rarely rewards effort. It rewards alignment. A good trade fits within the larger trend, respects key levels, and offers favorable risk without negotiation. When everything lines up, execution becomes simple. The trader doesn't feel clever, he feels prepared. He understands that forcing trades is an admission of impatience, while waiting for obvious ones is a mark of discipline. Anticipation feels harmless at first. It feels like preparation, like being ahead of the crowd. But in trading, anticipation is expensive. It pushes a trader to act before the market has finished speaking. Instead of waiting for confirmation, he starts trading possibilities, and possibilities have no obligation to pay. Have you ever entered a trade simply because you were sure it was about to move? When you anticipate, you borrow confidence from the future. You assume the market will agree with you soon. Until it does, you sit in uncertainty, watching every tick test your patience. That mental strain leads to poor decisions. Stops get widened. Rules get bent. Hope replaces discipline. The cost of anticipation isn't just financial, it erodes judgment. Markets are full of false starts. Breakouts fail, trends hesitate, levels get tested more than once. The trader who anticipates pays for each of these tests. The trader who waits lets others absorb that cost. Isn't it interesting how patience often means letting someone else be wrong first? Anticipation also creates attachment. Once you've decided what should happen, you start ignoring what is happening. You read the chart selectively. Weakness becomes temporary. Strength becomes almost there. This mindset keeps capital trapped in trades that never quite work. Waiting for confirmation shifts responsibility back to the market. Price must prove itself before money is committed. That approach shrinks losses before they occur. It also builds trust in the process rather than in predictions. Over time, anticipation drains accounts quietly, not through one large loss, but through many small ones that feel close to working. Those trades consume focus, energy, and capital. The disciplined trader learns to resist the urge to be early, to accept that missing a move is cheaper than forcing one, and to understand that the market pays for patience but charges interest on anticipation. As time passes and the chart continues to develop, and the trader chooses to protect his capital, rather than spend it on guesses that were never confirmed. Sitting tight is not about stubbornness, it's about protection. A trader who learns to sit tight understands that money is lost far faster than it is made, and that preservation is the foundation of every lasting account. When you rush from trade to trade, reacting to every fluctuation, you slowly dull your judgment. But when you sit tight, you give both your capital and your mind room to breathe. Have you ever noticed how mistakes multiply when you feel pressured to act? Protecting money isn't just about stops and position size. It's about choosing when not to engage. Every trade exposes you to risk, not only financially but mentally. Too much exposure leads to fatigue, and fatigue leads to careless decisions. Sitting tight reduces that wear and tear. It keeps your thinking sharp for the moments that matter. The same applies to mindset. Constant action creates emotional noise. Wins inflate confidence, losses bruise it, and soon the trader is no longer reading the chart, but reacting to his own feelings. Sitting tight quiets that noise. It allows emotions to settle so price can be seen clearly. Isn't clarity the real edge most traders are missing? When you protect capital, you also protect opportunity. Money tied up in weak trades is money unavailable for strong ones. Sitting tight ensures that when the right setup appears, you are ready, not distracted or depleted. It builds patience, discipline, and self-trust. Over time, this restraint compounds. The trader who sits tight trades less, but trades better. He avoids unnecessary losses and keeps his confidence intact. He learns that survival is not passive, that restraint is a form of control, and that by doing less, he often achieves more as the market continues to fluctuate and tempt him into action while he remains steady, focused, and aware that every decision to wait is an active choice to protect both his capital and his mindset, while the chart continues to evolve and the real opportunity slowly takes shape just beyond the noise. Overtrading often disguises itself as hard work. The trader feels busy, engaged, involved. He tells himself that effort equals progress. But the market doesn't measure effort, it measures discipline. Overtrading is usually impatience wearing the mask of productivity. Have you ever looked back at a series of trades and realized that most of them were unnecessary? The urge to trade frequently comes from discomfort with waiting. Silence on the chart feels like wasted time, so the trader fills it with action. He lowers his standards, takes marginal setups, trades inside ranges with no edge, all to avoid doing nothing. But every extra trade increases exposure, and increased exposure magnifies mistakes. Overtrading also fragments focus. Instead of waiting for one clear opportunity, the trader spreads attention across multiple positions, time frames, and ideas. Decision-making becomes reactive. Stops are adjusted emotionally. Losses stack up, not because the trader is wrong about the market, but because he is impatient with its pace. Isn't it strange how trading more often usually leads to understanding less? The market does not require constant participation. It rewards selectivity. The best trades often stand out clearly, but only to those who haven't exhausted themselves on noise. Overtrading dulls sensitivity to quality. After too many trades, even a good setup can be mishandled. Impatience also shortens perspective. The trader becomes focused on immediate results instead of long-term consistency. He chases small moves, trying to manufacture income from randomness. That mindset slowly erodes confidence and discipline. The disciplined trader understands that restraint is strength. Fewer trades mean clearer thinking. Waiting is not avoidance, it is preparation. By resisting the urge to overtrade, he aligns his activity with opportunity instead of emotion, recognizing that the market offers its best rewards to those who can remain calm, selective, and patient while others confuse motion with progress and trade, simply to satisfy the need to feel involved as time passes and the chart continues to evolve and the trader chooses discipline over impulse and quality while real opportunities quietly form. Ahead, waiting longer than others is not a matter of pride, it is a necessity learned through loss. Most traders act the moment they see something they recognize. They confuse recognition with readiness. The better trader recognizes the same thing and then waits. That waiting is the difference. Have you noticed how crowds rush in at the first sign of movement while professionals remain still? Waiting longer means letting the market remove doubt on its own. Early moves are messy. They are filled with false signals, emotional reactions, and weak hands. The trader who waits allows all of that to clear out. He doesn't need to prove he's right quickly. He needs the market to prove itself clearly. This kind of patience is uncomfortable because it goes against instinct. Doing nothing feels like falling behind. Watching others jump in creates pressure. But the market does not reward bravery, it rewards alignment. Waiting longer filters out bad trades before money is ever at risk. Isn't it interesting how the hardest discipline often produces the cleanest results? The trader who waits longer also protects his mindset. He avoids the emotional swings that come from early entries and unnecessary losses. His confidence is built on consistency, not excitement. He knows that being late to a good trade is better than being early to a bad one. Experience teaches that opportunities are not rare. Clarity is. Waiting longer sharpens the ability to recognize that clarity when it finally appears. The trader becomes selective, calm, and precise. He understands that most people lose money not because they lack opportunity, but because they lack patience. By waiting longer, he lets price confirm, structure develop, and risk define itself. He trades fewer times, but with greater conviction. He accepts that the market moves at its own pace, And that success belongs to those who can remain steady while others rush, who can sit with uncertainty without acting, who can resist the urge to be involved simply to feel productive, and who understand that the market always reveals its intentions in time to those disciplined enough to wait for them. Price is the final judge in the market. Opinions, forecasts, and theories all take a back seat once price begins to move. A trader who waits for price to prove itself understands this truth. He does not argue with the chart or impose expectations on it. He observes and responds. Have you ever held onto a belief about a stock even as price quietly moved against you? Proof in the market is not found in prediction, but in behavior. Higher highs, higher lows, clean breakouts with volume, strong reactions from key levels. These are the market's way of confirming direction. Until those signs appear, commitment is premature. Entering before proof means accepting uncertainty as risk. Waiting for proof means letting the market reduce that risk first. Many traders try to outsmart price. They buy because something looks cheap or sell because something feels expensive. But price does not care about feelings. It moves based on supply and demand, and it reveals that balance through action. The disciplined trader waits for that action. Isn't it strange how often price tells the truth after traders have already lost money? When price proves itself, execution becomes simpler. Stops make sense. Targets are logical. The trade no longer depends on hope. It depends on structure. That structure brings confidence, not excitement. Waiting for proof also builds trust in the process. Each confirmed trade reinforces discipline. Each avoided premature trade protects capital and confidence. Over time, this approach separates reaction from impulse. The trader who waits for price to prove itself accepts that he will miss the earliest part of some moves. He is willing to pay that price in exchange for clarity. He knows that the market always offers another opportunity, but it rarely forgives impatience, and that every time he waits for confirmation, he strengthens the habit of trading what is real instead of what is imagined, while the chart continues to evolve and the trader remains attentive, measured, and committed only when price has clearly earned that commitment. Risk is often treated as something that appears after a trade is placed, but experienced traders know better. Risk begins the moment you decide to act, and patience is the first tool for controlling it. By waiting, a trader allows uncertainty to shrink before capital is exposed. Isn't it easier to manage a trade when the market has already done some of the work for you? Impatience magnifies risk. Entering too early means wider stops, unclear levels, and greater emotional involvement. The trader must endure pullbacks, false moves, and hesitation before the market commits. All of that increases exposure. Waiting, on the other hand, lets structure form. Support and resistance become clearer. Trends define themselves. Risk becomes measurable. When patience is applied, profit is no longer the first consideration. Survival comes first. By reducing risk before thinking about reward, the trader stacks probabilities in his favor. A smaller risk does not guarantee profit, but it makes losses manageable. Isn't that the real edge most traders overlook? Markets constantly tempt traders to act early with the promise of greater reward. But that promise often hides hidden costs. The trader who waits accepts smaller initial gains in exchange for higher consistency. He trades less often, but with better odds. Waiting also strengthens discipline. It teaches the trader to respect the market's pace rather than his own urgency. Over time, this habit compounds. Losses become smaller. Confidence becomes steadier. Decision-making improves. The patient trader understands that profits grow from controlled risk, not reckless anticipation. By letting the market confirm direction, by waiting for clean entries and defined exits, he reduces uncertainty before money is ever at stake. He knows that every moment of patience spent waiting for clarity is an investment in longevity, that risk cannot be eliminated, but it can be shaped, and that shaping it begins long before the trade. While the chart is still forming, and the trader chooses restraint over impulse and preparation over haste, as the market slowly reveals when it is ready to be traded. Missing a trade feels painful in the moment. It triggers regret and self-doubt. But that feeling fades quickly compared to the lasting damage of a bad trade. A missed opportunity costs nothing. A poor decision costs capital, confidence, and clarity. Have you ever chased a move simply because you didn't want to feel left out? The fear of missing out pushes traders into low-quality setups. They enter late, ignore risk, and accept poor positioning just to be involved. Those trades often end in frustration. Missing a trade, on the other hand, leaves you free. Free to observe, free to wait, free to act when conditions are better. The market always offers another chance. Trends unfold over time, pullbacks occur, new setups form. A trader who misses one move has not missed the market, he has only avoided unnecessary risk. Isn't it interesting how patience turns regret into relief once you see how many moves fail? Bad trades have consequences beyond the loss itself. They occupy mental space. They create hesitation in future decisions. They erode trust in your process. A missed trade does none of that. It teaches restraint and reinforces discipline. Experienced traders learn to accept missed opportunities as part of the business. They understand that selectivity is strength. They would rather miss 10 trades than take one that doesn't meet their standards.